Finance Talk with Ameer. If you are a beginner and want to learn about the stock market, here are some basic concepts and steps to get you started. Educate yourself. Start by learning the basics of the stock market. Understand key terms such as stocks, shares, dividends, market capitalization, and different types of orders. Read books, take online courses, and follow reputable financial news sources to expand your knowledge. Set your financial goals. Set your financial goals for investing in the stock market. Are you looking for long-term growth or short-term gains? Do you have a specific savings goal in mind? Getting clear on your goals will help you make better investment decisions. Define your risk tolerance. Assess your level of risk tolerance. Be aware that the stock market carries inherent risks. It is essential that you are comfortable with the possibility of losing money. Generally, higher returns come with higher risks. Start with a budget. Determine how much money you can comfortably allocate to investing. It is recommended to start with a small amount. It gradually increase your investment as you gain experience. Choose an investment account. Choose an appropriate investment account based on your location and financial circumstances. Common options include individual brokerage accounts, retirement accounts, such as IRAs or 401ks, or tax-advantaged accounts, such as ISAs or SIPs, depending on your country. Choose a brokerage platform. Research and choose a reputable brokerage platform to execute your stock trades. Consider factors such as fees, user experience, customer support, research tools, and available investment options. Diversify your portfolio. Rather than investing all your money in one stock, diversify your holdings. Diversify your funds across industries, sectors, and asset classes to reduce risk. This can be achieved through individual stocks, exchange-traded funds, ETFs, or mutual funds. Do your research. Before investing in a particular stock, do a thorough research. Analyze the company's financial health, management team, competitive advantages, and industry trends. Track company financial statements, earnings reports, and news. Practice risk management. Implement risk management strategies to protect your investments. Set stop-loss orders to limit potential losses, avoid emotional decisions, and stick to your investment plan. Monitor and review. Regularly review the performance of your portfolio and make adjustments as needed. Stay informed about market trends, economic indicators, and any news that could affect your investments. Learn from mistakes. Mistakes and losses are part of the learning process. Take them as opportunities to improve your understanding and improve your future investment decisions. Dollar cost averaging. Consider using a strategy called dollar cost averaging. Instead of a one-time investment, invest a fixed amount at regular intervals, e.g. monthly or quarterly. This approach can help mitigate the impact of market volatility. It potentially yield favorable returns over time. Stay informed about market news. Stay informed about financial news, market trends, and economic indicators that can affect stock prices. Financial news, investment websites, and specialized market analysis platforms can provide valuable information. Avoid emotional decision-making. Emotions can cloud judgment when it comes to investing. Avoid impulsive decisions based on fear or greed. Stick to your investment plan and rationale and keep the long-term perspective in mind. Learn from successful investors. Study the strategies and philosophies of successful investors, such as Warren Buffett, Peter Lynch, or Benjamin Graham. Their insights can offer valuable lessons and principles to guide your own investment approach. Remember that the stock market is dynamic and complex, and there is always something to learn. Constantly educate yourself, adjust your strategies as needed, and be patient and focused on your long-term goals. Like, share, and subscribe.